The core of this video is a rotation plus timing thesis. Bitcoin's halving reduces new BTC supply, which tends to amplify bullish reflexivity when demand holds or rises. That initial wave usually concentrates in BTC first. It's the benchmark asset, the ETF or Treasury headline magnet, and the deepest liquidity pool, and only later rotates into higher beta assets like ETH as traders seek more upside per unit of capital. Your hook works because it compresses that entire macro behavior into one repeatable mental model, the same Ethereum cycle, and then immediately anchors attention with a concrete destination, 10K to 20K, and an appeal to pattern recognition rather than vibes. To make it land as data, not hype, you'll want to be very explicit that you're describing a historical tendency, rotation, and lag, not a guaranteed mechanism. Then you can still be bold about the setup while staying credible. When you explain why the halving matters for ETH, the most convincing way is to frame liquidity as a flowing risk curve. In the earliest phase of a cycle, marginal dollars prefer the asset with the clearest narrative and least slippage, BTC. As price discovery kicks in, profit-taking and risk appetite increase, and participants start climbing the risk curve into assets with higher beta and more narrative optionality, ETH, then large caps, then the long tail. This is where your ETH/BTC rotation visual becomes the hero, because it shows the behavior rather than asks viewers to trust you. Keep the halving explanation short and visual. Supply issuance dropping, market reacts, then capital rotates, then quickly bridge to the lag concept. ETH often underperforms early in the BTC leg, then outperforms once BTC confidence has been established. The key is to tell the viewer what to watch: ETH/BTC trend reversal, ETH dominance uptick, and confirmation that BTC is no longer the only trade. For the 2016 cycle segment, the goal isn't to impress with the biggest percentage number, it's to show a repeatable structure: deep drawdown, long boredom, explosive repricing. Emphasize that the accumulation window feels uncomfortable precisely because it's not rewarding in the moment. Low volatility, chop, constant bearish narratives, and opportunity cost versus whatever is pumping. This is where you narrate psychology. Retail typically exits during drawdowns and boredom, while longer horizon capital builds positions when attention is low. Visually, you want to highlight time more than candles. Shade the accumulation band, put a 546 days bracket across the bottom, and show that the parabolic phase happens after the market has exhausted both fear and impatience. That makes your later hardest time to buy quote feel earned rather than motivational. In the 2020 cycle section, you're reinforcing the rhymes idea by showing the same time structure but a different magnitude. That distinction is important for credibility. Repeating timing does not guarantee repeating returns because market cap, macro conditions, and adoption maturity change. Use that to your advantage. Same rhythm, different amplitude. This lets you keep the pattern thesis while defusing the common criticism that past percentage gains can't repeat forever. The history doesn't repeat, but it rhymes overlay should appear exactly when you compare the two accumulation brackets, not when price is already vertical, because the point is the structure, not the climax. For the 2024 cycle setup, you'll want to carefully handle "we're in it right now." The most persuasive language is conditional and measurable. If the cycle continues to rhyme, then this is what the accumulation window looks like, and here are the markers that tell us whether we're still on track. When you say 609 days ongoing and slightly delayed, you're introducing a very useful concept. Cycles can stretch due to macro tightening, rate regimes, and policy uncertainty, but stretched timing doesn't automatically break the structure. The way to make delay does not equal invalidation convincing is to immediately name what would be invalidation. You cover this later, but foreshadow it here. Structural demand failure, severe macro dislocation, or a regime shift in ETH's role. That keeps the viewer from feeling like you're hand-waving away inconvenient timing. When you explain the accumulation zone, $2,600 to $3,000, the winning move is to connect three things: historical analogs, on-chain behavior, and sentiment. Historical analogs give the viewer the map. On-chain gives the evidence, and sentiment gives the why it feels wrong. Even if you don't go deep into on-chain metrics, you can mention the types that matter without overfitting: exchange balances, selling pressure, long-term holder behavior, realized price bands, and activity/fees as a usage proxy. Then nail the boredom psychology. The market tries to convince participants that nothing will ever happen again. ETH is dead. It's a dinosaur. L2's killed it. Solana ate it, etc. And that narrative pressure is part of the accumulation process. The viewer should walk away with a simple takeaway. Accumulation is less about calling the bottom and more about surviving the narrative. For the 2026 price targets, you'll be most believable if you frame them as scenario bands tied to cycle behavior rather than precise predictions. Conservative should be justified by prior cycle percentage expansion from a mid-cycle base. Mid-range should assume stronger institutional access and improving liquidity. Aggressive should explicitly require euphoric conditions, broad risk-on, strong flows, and a full ETH as yield-bearing collateral narrative. When you say plus 1,000% to plus 1,500%, be careful. That depends heavily on the entry price you're implying. Make the math explicit on screen from a reference point, like from X dollars to 10K is Y%, because viewers instinctively distrust big numbers unless you show the base. This is also where it helps to acknowledge the diminishing returns effect as market cap grows. Then argue that ETFs, staking yield dynamics, and improved market infrastructure can partially offset that by expanding the addressable buyer pool. The Why 2026, not 2025 segment is where you turn the video from a hype pitch into a thesis. Your thesis should be halving effects propagate through liquidity and risk appetite with a lag. Rotation into ETH tends to occur after BTC establishes a new regime, and institutional timing often prefers clarity, products approved, narrative stabilized, volatility manageable. The ETH ETF and real yield framing fits here. You're not saying ETFs guarantee price, you're saying they can change the pathways for capital to access ETH, which can matter late cycle when marginal buyers need an easy on-ramp. If you present 2026 as cycle maturity rather than a date I like, it sounds analytical instead of prophetic. When you cover risks and invalidations, keep it blunt and specific so it doesn't feel like a legal disclaimer. Severe macro shock means what? Credit event, liquidity crisis, sustained restrictive policy that crushes risk assets? Structural ETH failure means what? Security crisis, loss of settlement premium, breakdown in fee dynamics, or a credible competitor capturing the monetary premium and developer mindshare? Regulatory black swans means what? Restrictions on staking, on-ramps, or custody in major jurisdictions? Then say the most important line in a calm voice. This is probabilistic. The tone shift is powerful. It signals maturity and builds trust right before you wrap. Your final summary should feel like a tight loop closure. You opened with same cycle, you showed two historical rhymes, you mapped the current phase, you gave scenario targets, and you named what would break the thesis. Then deliver the quote as a distillation of the emotional truth of accumulation. It feels worst right before it works. Don't overdramatize it. Say it like someone who's watched the movie before. For the CTA, make it participatory. Ask viewers whether they're accumulating or waiting, and tease the ETH versus SOL versus BTC comparison as the next logical question. If the thesis is right, which asset has the best risk-adjusted upside into 2026? One extra credibility boost, add a quick on-screen line like "not financial advice, educational thesis," and keep it there during the target section so your bold numbers don't trigger instant skepticism. If you want this to feel even more deep, the simplest upgrade is to add a recurring scoreboard overlay throughout the video with 3 to 5 trackable markers: ETH versus BTC trend, liquidity conditions proxy, ETF/flow narrative, on-chain accumulation proxy, sentiment index. Each time you transition segments, update the scoreboard with a quick checkmark or watch label. It turns your story into a framework viewers can revisit, which is exactly what makes long-form macro/crypto content shareable and sticky.